Something fundamental is shifting in the silver market. And if you hold paper silver contracts, ETFs, or mining shares, you need to understand what's happening right now. This isn't about predicting prices. This isn't about getting rich quick. This is about understanding a structural issue that's been building for years and may be reaching a critical point in 2026. I'm going to walk you through this calmly and clearly, because whether you currently own silver in any form or you're considering it, the relationship between paper silver and physical metal is changing in ways that will affect your investment decisions. Let me be direct with you. The silver market has always operated on a fractional reserve system. For every ounce of physical silver, there are multiple claims on that same ounce through paper contracts. This has worked for decades because most people never take delivery. They trade the contract, collect their profit or loss, and move on. But what happens when that assumption breaks down? In early 2026, we're seeing something we haven't seen before at this scale. The disconnect between paper silver prices and the actual availability of physical silver has widened to levels that serious analysts are calling unprecedented. Let me explain what I mean by this disconnect. When you buy a silver ETF or futures contract, you're buying a promise, a legal claim on silver. But you don't hold the metal. You hold a financial instrument that represents the metal. And for years, this system worked smoothly because liquidity was abundant and most participants were happy to settle in cash rather than metal. Today, physical silver premiums over spot prices have remained elevated for months. Delivery delays from major dealers have extended from days to weeks. And perhaps most significantly, institutional buyers who previously traded paper contracts are increasingly demanding physical delivery. This matters because the entire pricing mechanism for silver has been built on the paper market. The futures exchanges in London and New York determine the spot price. This price then flows down to every coin shop, every mining company valuation, every industrial contract. But if the paper price says silver is one number and you can't actually buy meaningful quantities of physical metal near that price, then what is the real price? This isn't a conspiracy theory. This is a structural question about market mechanics. And it's a question that becomes urgent when physical and paper markets begin to diverge. To understand why this is happening now, you need to understand the broader economic environment we're operating in. Global debt levels in 2026 have reached historic proportions. Governments across the developed world are running deficits that would have been unthinkable 2 decades ago. The United States alone carries debt exceeding $36 trillion, with interest payments consuming an increasing portion of the federal budget. When debt reaches these levels, governments face limited options. They can cut spending, which is politically difficult. They can raise taxes, which slows economic growth. Or they can manage the debt through monetary policy, which often means inflation. Central banks understand this dynamic perfectly. They also understand that modest inflation erodes the real value of debt over time. This isn't a secret. It's basic monetary economics. But the implications for hard assets are profound. Silver sits at an interesting intersection. It's an industrial metal used in solar panels, electronics, medical applications, and countless manufacturing processes. It's also a monetary metal with thousands of years of history as a store of value. And it's relatively scarce, with annual production measured in billions of ounces compared to gold's much smaller supply. When currency purchasing power declines, when debt levels rise, when trust in paper assets wavers, investors historically move toward tangible assets. This isn't speculation. This is documented behavior across centuries of market cycles. Here's where most commentary goes wrong. They focus on the price. They obsess over charts and technical patterns and short-term moves. They miss the bigger structural story. The paper silver market exists for legitimate reasons. It provides liquidity. It allows miners to hedge production. It lets industrial users lock in future prices. It enables speculators to provide market depth. These are all valuable functions in a well-operating market. The problem emerges when the paper market becomes disconnected from the physical reality it's supposed to represent. Think about it this way. If a futures contract says silver is trading at a certain price, but refineries are backed up for months, dealers are charging substantial premiums, and delivery times keep extending, then the futures price is giving you information about the paper market, not the physical market. And which market matters more? The one where financial contracts change hands, or the one where actual metal moves from sellers to buyers? Most investors don't think about this distinction until it matters. They assume the two markets are basically the same thing with slightly different prices. They're not. They're different systems with different dynamics, different participants, and potentially different outcomes during stress. The paper market is enormous. Daily trading volume in silver futures dwarfs actual annual mine production. This leverage provides liquidity in normal times, but it also means that relatively small shifts in physical demand can create disproportionate stress on the system. We've seen versions of this story before in other markets. Not exactly the same, but similar enough to learn from. In the late 1960s and early 1970s, the London Gold Pool attempted to suppress gold prices through coordinated central bank selling and paper market operations. It worked until it didn't. When physical demand exceeded what the system could deliver, the gold pool collapsed and the price of gold eventually rose by multiples. More recently, we've seen moments of stress in the paper gold market where delivery requests spiked and premiums on physical metal surged. These episodes were usually temporary because the underlying system remained functional. But each episode also revealed the same basic truth. Paper claims on an asset are only as good as the system's ability to deliver the underlying asset when demanded. The question isn't whether this can happen. History shows it can. The question is whether conditions exist now that could push the silver market toward a similar divergence. Several factors suggest we may be approaching that point. Silver mining is not easy to scale quickly. Most silver comes as a byproduct of mining for other metals like copper, lead, and zinc. Primary silver mines exist, but they represent a minority of total production. This means that even if silver prices rise significantly, production doesn't automatically increase in response. The supply side has limited elasticity compared to many other commodities. At the same time, industrial demand for silver continues growing. The solar panel industry alone has become a massive consumer of silver. Electric vehicles use more silver than traditional cars. 5G infrastructure requires silver. Medical applications continue expanding. Some of this industrial demand is price insensitive. A solar panel manufacturer needs a certain amount of silver per panel. If silver prices rise, they may try to reduce usage or find substitutes, but these changes take time. In the short to medium term, they need the silver regardless of price. Now, layer on investment demand. When investors globally begin questioning currency stability, when inflation remains persistent, when geopolitical tensions create uncertainty, a portion of global wealth flows toward precious metals. This investment demand is different from industrial demand. Industrial users need silver for production. Investors want silver for preservation. And critically, investors taking physical delivery remove metal from the available supply pool, while industrial users consume it permanently. The math becomes challenging. If annual mine production is roughly 1 billion ounces, and industrial demand approaches that same level, there's limited room for new investment demand before the market tightens. This is the supply-side reality that makes the paper market's leverage potentially problematic. If you currently hold silver through ETFs, futures contracts, mining stocks, or other paper instruments, you need to understand what you actually own. A silver ETF is not silver. It's a security that holds silver or claims on silver and issues shares against those holdings. In many cases, these funds have worked well for investors who wanted silver exposure without the hassle of physical storage, but they operate under specific legal structures and face specific risks. Read your fund's prospectus carefully. Understand whether it holds allocated physical silver or unallocated claims. Understand what happens during market stress. Understand the counterparty relationships involved. Some ETFs allow large institutional holders to redeem shares for physical metal. Others don't. Some have clear one-to-one backing. Others use complex structures involving multiple parties and jurisdictions. These details matter immensely if the paper and physical markets begin to diverge. Futures contracts are even more directly exposed to this risk. A futures contract is a legal obligation between two parties. If you're long silver futures, you have the right to demand delivery. But if the short side cannot or will not deliver, your remedy is typically cash settlement at the contract price, not receiving the metal. In a situation where physical silver is trading at a significant premium to the paper price, cash settlement at the paper price means you've effectively lost the difference. Mining stocks are a different category entirely. You're not holding silver. You're holding equity in a company that produces or explores for silver. These stocks can be leveraged plays on silver prices, but they also carry company-specific risks, management risks, operational risks, and jurisdictional risks. During previous precious metals bull markets, mining stocks have sometimes outperformed the underlying metals significantly. They've also sometimes underperformed or even declined while metal prices rose. There's no automatic correlation. The key point is this. If you hold paper silver, you need to understand exactly what rights and risks you have if the system faces stress. Assumptions that worked in the past may not hold during a structural shift. For those who don't currently own silver in any form, this situation presents both opportunity and risk. The opportunity is that you can enter a position with full awareness of the structural dynamics at play. You can make informed decisions about which form of silver ownership makes sense for your situation and goals. The risk is entering at the wrong time, in the wrong form, or with unrealistic expectations. Let me be clear about something. Silver is volatile, always has been. The silver market is smaller than gold, more industrial, more speculative, and more prone to sharp moves in both directions. If you cannot tolerate significant price fluctuations, silver may not be appropriate for you regardless of the structural story. But if you understand that volatility, and you're thinking in terms of years rather than months, then understanding the paper versus physical dynamic becomes part of your decision framework. If you believe that currency debasement will continue, that debt levels will keep rising, that inflation will remain persistent, and that tangible assets will preserve purchasing power better than paper assets, then owning some silver may make sense as part of a diversified strategy. The question then becomes, which form of silver? Physical silver requires secure storage. It's liquid compared to ETFs. You'll pay premiums when buying and take discounts when selling. It's heavy and inconvenient, but it's yours. No counterparty risk, no questions about whether it exists. It's in your possession or in a vault you control. Paper silver is convenient. It trades instantly. It fits easily in a brokerage account. But it comes with the structural questions we've been discussing. In normal markets, this distinction doesn't matter much. In stressed markets, it might matter enormously. The right answer depends on your individual circumstances, risk tolerance, time horizon, and financial goals. But you should make that choice with eyes open to the trade-offs involved. Markets are made by people, and people are emotional. This is true in all markets, but especially true in precious metals, markets where the assets themselves carry psychological weight beyond their utility. During periods of economic uncertainty, fear drives behavior. Investors who dismissed precious metals during good times suddenly become interested. This increased demand can become self-reinforcing, pushing prices higher, which attracts more attention, which brings more buyers. But fear-driven buying is also impulsive and often poorly timed. The worst decisions in any market are usually made at emotional extremes. Buying silver because you're panicked about the financial system collapsing tomorrow is not a sound investment strategy. Conversely, long-term positioning in hard assets based on sober assessment of debt levels, currency policies, and historical patterns is different. It's not about panic, it's about probability. The investors who do well in precious metals are typically those who build positions gradually over time without trying to time the market perfectly. They understand that volatility is the price of admission. They don't sell when prices drop temporarily. They don't get overexcited when prices spike. They're thinking in terms of purchasing power preservation over years or decades, not quick profits over weeks or months. This mindset is critical because the silver market will test your emotions. It always does. Prices will swing wildly. News will alternate between bullish and bearish. Social media will be filled with both excessive optimism and excessive pessimism. If you don't have a clear framework for why you own silver, what conditions would cause you to add to positions, and what would cause you to reduce positions, you'll likely make emotional decisions at precisely the wrong times. One aspect of silver that distinguishes it from gold is its heavy industrial use. This creates both opportunities and complexities. Industrial demand provides a fundamental floor under silver prices. Companies need silver for production. As long as modern technology continues advancing, industrial silver consumption will likely remain strong or grow. But industrial demand also means that economic recessions can temporarily reduce silver consumption, putting downward pressure on prices even if investment demand remains strong. This dual nature, a monetary asset and industrial commodity, makes silver's price behavior less predictable than gold's. Gold is almost entirely a monetary asset. Its price reflects monetary factors, investment demand, and central bank policies. Silver reflects all of those factors plus industrial economic cycles. Sophisticated investors recognize this complexity. They understand that silver can perform very well during inflationary periods with strong industrial growth. It can also perform well during economic stress when monetary factors dominate, but it can face headwinds if industrial demand collapses while investment demand hasn't yet fully compensated. The current environment in 2026 is interesting because we're seeing both monetary concerns and strong industrial demand trends in areas like renewable energy. This combination historically has been favorable for silver prices over multi-year periods, but again, short-term volatility can override longer-term fundamentals for extended periods. Markets can remain irrational longer than individual investors can remain solvent, as the famous saying goes. Let me now address what I consider the most important section of this entire discussion: the mistakes to avoid. First, do not make investment decisions based on headlines or short-term price movements. The silver market generates endless commentary, much of it conflicting, most of it noise. Focus on fundamentals, structural trends, and your own financial situation. Ignore the daily chaos. Second, do not over-leverage. Some investors, excited by potential silver price appreciation, buy using margin, take out loans, or allocate disproportionate portions of their net worth to precious metals. This is dangerous. If you own so much silver that a temporary price decline creates financial stress, you own too much. Size your positions appropriately. Third, do not assume that paper silver and physical silver will always trade at similar prices. This is the core point of this entire discussion. The structural dynamics suggest they may diverge. Don't make investment decisions that assume perfect substitutability if that assumption may not hold. Fourth, do not chase price spikes. When silver prices surge rapidly, inexperienced investors often rush in near the top, then panic sell during inevitable corrections. This pattern repeats endlessly. If you want to own silver, build positions gradually during periods of price weakness, not during moments of peak excitement. Fifth, do not neglect basic risk management. Silver should be part of a broader financial strategy that includes emergency savings, appropriate insurance, income stability, and diversified investments. It's not a replacement for financial fundamentals. It's a complement to them. Sixth, do not believe anyone who claims to know exactly where silver prices are going. No one knows. The analysts who speak with the most certainty are usually the least reliable. Market outcomes depend on countless variables, many of them unpredictable. Focus on probabilities and risk-reward ratios, not certainty. Seventh, do not ignore counterparty risk if you hold paper silver. Understand exactly what you own, who your counterparties are, and what could happen to your holdings during system stress. This due diligence is not paranoia. It's prudent risk management. Eighth, do not follow social media hype blindly. Online communities around precious metals can become echo chambers where unrealistic expectations get reinforced and dissenting views get dismissed. Stay grounded, stay skeptical, stay rational. Instead of thinking in terms of predictions, think in terms of probabilities and scenarios. Scenario 1, the current system continues functioning smoothly. Paper and physical silver markets remain closely linked. Prices fluctuate, but the fundamental structure holds. In this scenario, holding either paper or physical silver provides similar results, with physical having the disadvantage of storage costs and premiums. Scenario 2, economic stress increases, but the silver market remains orderly. Prices potentially rise as investment demand grows, but the paper market continues functioning. Industrial demand remains strong. Both paper and physical silver perform well, though physical may command higher premiums. Scenario 3, the paper and physical markets begin to diverge significantly. Physical silver becomes difficult to obtain at prices close to the paper market price. Premiums widen substantially. The paper market faces delivery challenges. In this scenario, physical silver substantially outperforms paper silver, and the entire pricing mechanism comes into question. Scenario 4. Broader financial system stress creates chaos across multiple markets. Silver volatility increases dramatically. Markets become temporarily dysfunctional. Eventually, the system resets or stabilizes, but the transition period is turbulent. In this scenario, physical silver provides insurance value but may be difficult to trade efficiently. You don't need to assign precise probabilities to these scenarios. You just need to recognize that multiple outcomes are possible, each with different implications for your holdings. If you hold only paper silver, you're implicitly betting that scenarios 1 or 2 occur. If you hold physical silver, you're acknowledging that scenarios 3 or 4, while perhaps less likely, could happen and would make physical ownership valuable. The right allocation depends on your assessment of these probabilities and your personal risk tolerance. Precious metals move in long cycles, typically measured in decades rather than years. Understanding where we are in these cycles matters for long-term positioning. From 2001 to 2011, silver went through a major bull market, rising from roughly $4 to nearly $50 at the peak. This was driven by monetary expansion following the 2008 financial crisis, concerns about currency debasement, and strong industrial demand from emerging markets. From 2011 to 2020, silver experienced a brutal bear market and then a long consolidation. Prices dropped below $14 at one point. Interest waned. The narrative shifted away from precious metals toward technology stocks and growth assets. Since 2020, we've seen renewed interest, driven initially by pandemic-related monetary stimulus, then by inflation concerns, then by ongoing geopolitical tensions and debt worries. Silver has been volatile, but generally trending higher from the lows. If we're entering a new long-term cycle driven by structural monetary issues, then we're potentially in the early to middle stages. If this is just another false start, we may see silver drop back toward previous trading ranges. The point is that these cycles take years to play out. Trying to trade in and out of silver based on short-term moves is difficult and usually counterproductive. The investors who benefit most from these cycles are those who recognize them early, position accordingly, and hold through the volatility. This requires patience, emotional discipline, and a genuine understanding of why you own the asset. It's not exciting, it's not dramatic, but it's how wealth preservation actually works. If you currently hold silver in any form, your primary task now is review and verification. If you hold physical silver, ensure it's stored securely. If you hold it yourself, consider how you would prove ownership if needed. If it's in a vault, understand the legal structure, the insurance coverage, and the process for taking possession if desired. If you hold paper silver, read the documentation carefully. Understand the difference between allocated and unallocated holdings. Understand redemption procedures, settlement mechanisms, and what happens during market disruptions. If you hold mining stocks, review the company's financial health, production costs, reserve quality, and jurisdictional risks. Mining stocks are not a direct substitute for metal ownership, but they can be valuable as part of a diversified precious metals position. Consider whether your current allocation remains appropriate given your overall financial situation. Has silver become a larger percentage of your net worth due to price appreciation? If so, rebalancing might be prudent even if you remain long-term bullish. Most importantly, define your exit criteria. Under what conditions would you reduce or eliminate silver holdings? If you can't answer that question, you're at risk of holding through any price level without a clear plan. Disciplined investing requires both entry criteria and exit criteria. Without both, you're just reacting to price movements rather than executing a strategy. If you're considering entering a silver position, approach the decision systematically. First, understand your motivation. Are you positioning for long-term purchasing power preservation? Are you speculating on price appreciation? Are you hedging other portfolio risks? Different motivations suggest different approaches. Second, determine appropriate allocation. For most investors, precious metals should represent a modest portion of overall net worth, typically somewhere between 5 and 20%, depending on individual circumstances and risk tolerance. This isn't a rule, but it's a starting framework. Third, decide between physical and paper based on your priorities. If counterparty risk concerns you, physical makes sense despite the inconvenience. If liquidity and ease of trading matter more, paper instruments may be appropriate. You can also split your allocation between both. Fourth, plan your entry strategy. Rather than investing a lump sum all at once, consider dollar cost averaging over several months. This reduces timing risk and removes some of the emotional pressure from trying to find the perfect entry point. Fifth, educate yourself continuously. Read broadly. Study monetary history. Understand market cycles. Follow credible analysts, but think independently. The more you understand the fundamentals, the less you'll be swayed by short-term volatility. Sixth, prepare psychologically for volatility. Silver will test your conviction. Prices will drop when you least expect it. They'll rise when skepticism is highest. Your ability to maintain discipline during these swings will largely determine your results. None of this exists in a vacuum. Silver is one asset within a complex global financial system undergoing significant change. We're living through a period of unprecedented monetary experimentation. Debt levels that would have been considered impossible are now routine. Central bank balance sheets have expanded by multiples. Government spending patterns have shifted dramatically. Currency relationships are evolving. At the same time, geopolitical tensions are rising. Supply chain vulnerabilities have been exposed. Trust in institutions has declined. Technology is reshaping how value is stored and transferred. Silver isn't a solution to all these challenges. It's simply one option for preserving purchasing power and diversifying risk during uncertain times. The investors who navigate this environment successfully will be those who remain adaptable, who think independently, who manage risk carefully, and who avoid dogmatic attachment to any single asset or ideology. Silver has a role to play in that kind of balanced approach. But it's a role, not the entirety of the strategy. Ultimately, the entire discussion about paper versus physical silver comes down to a question of trust. Do you trust the paper market to function smoothly during stress? Do you trust counterparties to honor their obligations? Do you trust the pricing mechanism to remain connected to physical reality? These aren't paranoid questions. They're legitimate risk assessment questions. Systems can and do break down when stressed beyond their capacity. It's happened before in various markets and contexts. It will happen again somewhere, sometime. The question isn't whether such breakdowns are possible. The question is whether the specific conditions exist now to make such a breakdown probable in the silver market specifically. Reasonable people can disagree on that probability assessment. What's not reasonable is failing to ask the question at all. If you hold or are considering paper silver, you're implicitly trusting a complex system of intermediaries, legal structures, and market mechanisms. That trust may be well placed. The system may continue working perfectly well. But you should at least be aware that you're extending that trust and understand what could happen if it's misplaced. Physical silver removes that layer of trust from the equation. You hold the metal, you control it, no intermediaries necessary. Of course, you then need to trust your storage solution and your ability to sell the metal when desired. No solution is entirely risk-free. The point is to make conscious choices with awareness of the trade-offs rather than drifting into positions without understanding what you truly own. I want to emphasize this point strongly because it's the foundation of sound investment thinking. You cannot predict the future, neither can I. Neither can anyone, regardless of their credentials or confidence level. What you can do is prepare for multiple possible futures by understanding risks, diversifying appropriately, and positioning yourself to benefit from probable scenarios while protecting against adverse ones. This is what professional risk management looks like. It's not sexy, it doesn't make dramatic YouTube thumbnails, but it's how serious money is actually managed. In the context of silver, this means recognizing that the structural concerns about paper market leverage are real and worth consideration, while also acknowledging that these concerns could take years to manifest or might never create the dramatic crisis some expect. It means holding appropriate positions based on your circumstances, maintaining discipline through volatility, and adjusting as new information emerges rather than either ignoring risks entirely or panicking into extreme positions. The investors who preserve and grow wealth over decades are not the ones making the boldest predictions. They're the ones making the most thoughtful preparations. We've covered a lot of ground. Now let me bring this together with some final perspective. The relationship between paper silver and physical silver is worth watching closely in 2026. The structural dynamics suggest potential stress points that haven't existed at this scale before. Whether these stress points actually materialize into a genuine crisis remains to be seen. What's clear is that the assumptions underlying the paper silver market, assumptions about liquidity, delivery, and arbitrage keeping paper and physical prices aligned, are being tested in new ways. For current holders, this means reviewing what you actually own, understanding your counterparty risks, and ensuring your positions align with your goals and risk tolerance. For potential buyers, this means making informed decisions about which form of silver ownership makes sense for your situation, entering positions gradually, and preparing psychologically for volatility. For everyone, this means maintaining emotional discipline, thinking in probabilities rather than certainties, and focusing on long-term purchasing power preservation rather than short-term price predictions. The silver market will remain volatile, prices will swing, headlines will alternate between bullish and bearish, social media will be filled with noise. Through all of this, the fundamentals of sound investing remain unchanged. Understand what you own. Know why you own it. Size positions appropriately. Manage risk carefully. Think independently. Stay patient. Remain disciplined. These principles apply to silver. They apply to every asset. They're not exciting, but they work. The monetary landscape is changing. Debt levels continue rising. Currency policies remain accommodative. Inflation persists despite attempts to control it. These are the conditions in which hard assets historically have provided value as portfolio diversifiers and purchasing power preservatives. Silver occupies a unique position in this environment, part monetary asset, part industrial commodity, smaller and more volatile than gold, but also potentially more leveraged to the same fundamental dynamics. Whether the paper-physical disconnect becomes a genuine crisis or remains a manageable premium is something we'll discover over the coming months and years. What matters is that you're aware of the dynamics, you've made informed decisions based on your individual circumstances, and you're prepared to adjust as the situation evolves. No investment is perfect. Every asset carries risks. The goal isn't to eliminate risk entirely. That's impossible. The goal is to understand risks, manage them appropriately, and position yourself for probable scenarios while maintaining flexibility. If you've watched this entire video, you're already ahead of most investors. You're thinking about structural issues rather than just price charts. You're considering counterparty risks rather than assuming everything works perfectly. You're approaching this as a serious investor rather than a speculator chasing quick profits. That mindset matters more than any specific position. Markets reward patience, discipline, and independent thinking over time. They punish emotional reactions, over-leveraging, and herd mentality. Stay informed, stay rational, stay disciplined. Understand cycles, prepare for multiple scenarios, manage your emotions, focus on fundamentals. These principles have guided successful investors through every market environment in history. They'll continue working regardless of what happens next in the silver market. The crisis that may or may not be here isn't something to panic about. It's something to understand, prepare for, and navigate with clear thinking and steady nerves. That's how real wealth is preserved and grown over time. Not through perfect predictions, but through thoughtful preparation and disciplined execution. Thank you for investing your time in understanding these dynamics. Use this information to make better decisions for your specific situation. And remember, the goal isn't to be right about every market move. The goal is to be prepared for whatever comes and to stay in the game long enough for sound strategy to compound over time.